Here is what nobody in the precious metals community wants to admit out loud. The moment you sell, the story changes completely. There is a ritual familiar to anyone who has ever walked into a coin shop, refreshed a spot price ticker at midnight, or felt the particular satisfaction of stacking another tube of silver eagles in a safe that clicks shut with the quiet authority of something real. The ritual is the purchase, the buying, the holding, and in that holding, there is a certain philosophical comfort. The sense that one has stepped, however briefly, outside the churning machinery of modern finance and found something ancient, something honest, something that governments cannot simply conjure into existence with a keyboard and an accommodating central bank. That feeling is not entirely wrong, but it is dangerously incomplete. Because here is the uncomfortable truth that precious metals dealers rarely volunteer when they are happily processing your order. The Internal Revenue Service does not share your philosophical convictions. It does not care about your theory of sound money. It does not recognize the emotional distinction between paper wealth and real wealth. What it recognizes with the calm and implacable efficiency of an institution that has been collecting taxes since before most of the metals in your safe were ever mined is gain, realized gain, documented gain, and increasingly, in 2026, reported gain, whether you expected a form in the mail or not. The IRS has revised the precious metals language in the Form 1099-B instructions, and most stackers, the people most directly affected by this change, still have no clear idea what it means in practice. This is not a coincidence. It is a consequence of an information ecosystem that has, for years, been far more enthusiastic about selling the dream of financial independence than explaining the tax code that governs the exit from that dream. The result is a community of intelligent, well-intentioned people who know the difference between a proof coin and a bullion coin, but cannot tell you whether their silver sale last year was a short-term or long-term event, or what rate applied, or why the absence of a 1099 form in their mailbox did not legally, practically, definitively mean the transaction was invisible. It was not invisible. It never was. And in 2026, the framework for understanding why has become sharper, more specific, and considerably less forgiving of the kind of cheerful improvisation that has characterized precious metals tax compliance for too long. Let us begin with what the law actually says, because there is no substitute for precision when the subject is your own money and the entity on the other side of the ledger has subpoena power. Physical gold and silver are classified, for federal tax purposes, as collectibles, not investments, not currency. Collectibles, the same category that encompasses fine art, antique furniture, and vintage wine. That classification carries consequences that most stackers have never fully internalized, and those consequences do not become negotiable simply because one finds them inconvenient. When you sell a collectible at a gain, the maximum federal long-term capital gains rate is 28%, not 15, not 20, 28. That rate has existed for years, and yet it continues to surprise people who assumed their gold was taxed like their index funds. It is not. It never has been. And if you held the metal for 1 year or less before selling, the gain is treated as ordinary income, taxed at whatever marginal rate applies to the rest of your earnings, which in some brackets is considerably more punishing than 28%. This is the architecture of the law before we ever get to the question of reporting, and that architecture matters because a great deal of online discourse about precious metals taxation begins and ends with the reporting question. Will a form be filed? Will the government know? Can the transaction be structured to avoid detection, while barely touching the more fundamental question of what you actually owe and why? The reporting question is real and worth examining carefully, but it is downstream of the tax question, and confusing the two has cost a great many stackers a great deal of money. Now here is what the 2026 revision actually changes, stated plainly. The IRS has clarified that sales of precious metals for a single customer during a 24-hour period must be aggregated and treated as a single sale when determining whether a reporting exception applies. Sales during a 24-hour window do not become separate transactions simply because they are processed on separate receipts. The IRS is looking at substance, not form. It is asking what actually happened, not how the paperwork was arranged. If you have spent any time in precious metals forms, you will recognize immediately what this clarification is designed to address. There is a persistent and dangerous myth, repeated with the confidence of folk wisdom, that one can divide a large sale into smaller pieces and thereby escape both reporting obligations and, by some magical thinking, the underlying tax liability. That myth has now been addressed with the kind of bureaucratic finality that tends to concentrate the mind. The aggregation rule is not new in spirit. What is new is the explicitness with which it has been stated. And explicitness, in tax law, is rarely accidental. And remember, if you find this kind of financial education valuable, The single most powerful thing you can do right now is hit that subscribe button, because what is coming in the next two parts of this video is information that most CPAs never think to explain to their stacking clients, and it could save you from an expensive mistake that is entirely avoidable if you simply know the rules in advance. The absence of a form is not the absence of a liability. Write that down. Tattoo it somewhere visible, because the confusion between those two things is the engine of most precious metals tax mistakes. There is a seductive logic to the idea that reporting and taxation are the same event, that if no form arrives in January, no obligation exists in April. It is the kind of logic that feels sound until one examines it, at which point it collapses with remarkable speed. A 1099-B is an information document. It tells the IRS what a broker or dealer reported. It does not create your tax liability. Your tax liability is created by the Internal Revenue Code, which has been perfectly clear on the treatment of collectible gains for decades. The form is a cross-reference, a data point, a piece of the government's audit architecture. Its absence means only that a particular form was not filed, not that the underlying transaction ceased to have tax consequences. This distinction matters more in 2026 than it did 5 years ago because the IRS has significantly expanded its capacity to identify discrepancies between what taxpayers report and what financial institutions report. The matching program that processes 1099 data is not the only mechanism. Bank Secrecy Act reports, cash transaction forms, and the aggregation rules now codified in the 1099-B instructions all feed into a compliance picture that is considerably more complete than most retail stackers imagine. The idea that physical precious metals exist in some reporting shadow zone, a comfortable gray area where transactions simply vanish, is a fantasy. It always was. But in 2026, it is a fantasy with increasingly expensive consequences. Now let us examine the 4 categories of stackers who are most exposed to these consequences, because the risk is not distributed evenly, and understanding where you stand is the beginning of managing it intelligently. The first category is the person who accumulated silver over many years without keeping records. This is more common than one might expect among people who began stacking before the practice became mainstream. Before the YouTube channels and the online communities and the spreadsheet templates, they know, in the general sense, what they paid. They remember that silver was cheaper then, but they cannot document cost basis with the precision a tax return requires. And in the absence of documentation, the IRS is not obliged to take one's word for it. The basis defaults, in the worst case, to 0 EUR, which means the entire proceeds of the sale become taxable gain. That outcome is financially brutal and entirely preventable with a ledger and a filing habit. The second category is the heir. Someone dies and leaves behind a collection of coins, bars, and rounds accumulated over decades. The heir knows the metals are valuable. The heir may not know what the original owner paid when they paid it, or whether the estate properly established the stepped-up basis that death provides under current law. The stepped-up basis is one of the genuinely significant tax benefits available to heirs. It resets the cost basis to fair market value at the date of death, potentially eliminating years of accumulated gain from the taxable picture. But claiming it requires documentation. Without it, the heir is navigating a tax situation with a map that has crucial sections missing. The third category is the retiree, who uses silver as a liquidity reserve, a hedge fund of last resort for medical expenses, home repairs, or family emergencies. The tax consequences of liquidating metals in retirement are not merely about the capital gains rate, they extend into the broader income picture. In a year when an unexpected silver sale pushes total income above certain thresholds, Medicare premium surcharges can activate. The income-related monthly adjustment amount, which can add hundreds of dollars per month to healthcare costs. The sale that felt like a practical solution to a financial problem becomes the trigger for a cascade of income-based calculations that the retiree did not anticipate, because nobody explained that investment decisions and healthcare costs are, in the modern regulatory environment, inextricably linked. The fourth category is the person who believes they have found a structural workaround, who has heard from some corner of the internet that splitting sales, timing transactions carefully, or paying in cash creates a kind of fiscal invisibility. The aggregation rule is the direct response to this belief. When the IRS says that sales during a 24-hour period for the same customer must be treated as one transaction, it is not speaking theoretically. It is describing the standard against which dealer reporting obligations will be measured, and it is implicitly warning the taxpayer that what looks like 4 small sales may be, in substance and in law, one large one. There is also the separate and frequently misunderstood question of cash reporting. Form 8.3. 00 requires dealers to report cash purchases of more than $10,000 in a single transaction or related transactions. This is not a precious metals tax, it is a Bank Secrecy Act compliance obligation. But it matters for the stacker who believes that cash payments create privacy because the dealer has a legal obligation that operates independently of the stacker's preferences. The cash reporting rule and the sales reporting rule are distinct, both exist, both have consequences, and knowing only one of them while being ignorant of the other is a meaningful gap in one's compliance knowledge. What all four of these categories have in common is that the risk is not created by bad intent. It is created by incomplete information combined with the entirely human tendency to assume that complexity, when it is inconvenient, will somehow resolve itself in one's favor. Tax law does not make that assumption. It proceeds from the text, not from what one hoped the text would say. The practical implication is straightforward, if somewhat demanding. Record keeping is not optional, and it is not separable from the investment itself. The purchase date, the product description, the quantity, the price paid, the dealer invoice, the shipping cost if it is part of basis, the sale date, the proceeds. These are not bureaucratic nuisances. They are the evidence that the tax system requires before it will accept your representation of the gain. Without them, you are not being unconventional. You are being vulnerable. Let us dispose of a myth before we conclude, because myths in this space have a particular staying power that is disproportionate to their accuracy. There is no new law confiscating silver. There is no national registry of precious metals owners. There is no sudden crackdown that did not exist a year ago. The headlines that have circulated in 2026 suggesting otherwise are, to put it with the precision the subject deserves, wrong. What exists is a clarification, specific, technical, carefully worded, of how dealer reporting obligations work under Form 1099-B. That clarification is meaningful. It is worth understanding. But it is not a confiscation order, and treating it as one is both factually incorrect and practically counterproductive, because panic is an exceptionally poor substitute for competence. The IRS correction removes an example from the precious metals section of the 1099-B instructions and adds the aggregation language that addresses structured sales. It does not create new taxes on silver ownership. It does not require individuals to register their holdings. It does not impose a $600 reporting threshold on private precious metals transactions. It addresses dealer reporting obligations in specific, defined circumstances. The appropriate response to that clarification is not alarm, it is attention. And attention in this context means understanding 5 things with the kind of clarity that survives a conversation with a tax preparer. First, the collectible tax classification applies to physical gold, silver, platinum, and palladium. That classification carries the 28% maximum long-term rate and the ordinary income treatment for short-term holds. Second, the reporting rules that govern dealers are distinct from the tax obligations that govern you. A dealer's failure to file a form does not change what you owe. Third, the aggregation rule means that structuring sales to avoid reporting is not merely ineffective. It is specifically the behavior the rule is designed to identify and address. Fourth, cash purchases above certain thresholds trigger a separate reporting obligation for the dealer under Form 8300, entirely independent of the sales reporting framework. Fifth, the gain exists when you sell at a profit, regardless of what forms arrive in the mail. Now let us make this concrete, because abstraction in tax discussions has a way of letting people convince themselves that the rules apply to some other taxpayer in some other situation. Consider a stacker who purchased 1,000 ounces of silver over several years at an average cost of $22 per ounce. That is a $22,000 cost basis. Silver rises. The stacker sells those ounces at $33. The proceeds are $33,000. The gain is $11,000 before adjustments. If the holding period qualifies as long-term, the collectible rate may apply. If the stacker is a Medicare beneficiary and the added income crosses a threshold, premium surcharges may follow. If the stacker cannot document the cost basis, the tax calculation becomes far more complicated and potentially far more expensive. And if the stacker split the sale into pieces during a single day to avoid a reporting threshold, the aggregation rule may have already treated it as one transaction. That single example contains every element we have discussed. It is not a hypothetical constructed to frighten. It is the ordinary situation of an ordinary stacker who bought metal for reasonable reasons, held it through a price cycle, and arrived at the selling decision without having thought carefully about what happens next. What happens next is determined not by what one hoped the tax code would say, but by what it actually says. The stackers who will navigate 2026 well are not the ones who found the cleverest workaround. They are the ones who kept the records. They are the ones who understood before they sold, not after, what the tax consequences would be. They are the ones who spoke to a tax professional in October rather than in April. They are the ones who recognize that a physical asset held outside the traditional financial system is still governed by the tax code when it changes hands, and that governing is thorough, patient, and increasingly well-informed. There is a version of this story that ends well. It ends well when the stacker who bought at the right time, held through the right cycle, and sold at a meaningful gain does so with a clean record, a documented basis, a realistic understanding of the tax bill, and a plan that accounts for all of it. That version of the story produces exactly the outcome the stacker intended when they began. Real wealth, protected purchasing power, a hedge that worked. The tax is real, but so is the gain. And a well-planned exit preserves far more of that gain than an improvised one. The version that ends badly begins with the assumption that the rules are someone else's problem, that paperwork is for people who lack conviction, that the absence of a form means the absence of a consequence. That version ends in an accountant's office in March with a stack of receipts that don't quite add up, and a tax bill that is larger than anyone expected, because the cost basis cannot be proven, and the holding periods were never tracked, and the structure of the sale turned out not to be as clever as it seemed at the time. The choice between those two versions is made not at the point of sale, but at the point of purchase, when the records begin, or don't. It is made in the years of holding, when the ledger is maintained, or isn't. And it is made in the moment before the sale, when the tax professional is consulted, or when that conversation is deferred until the gain is already locked in and the options have narrowed. Now, and this is important, drop a comment below and tell me, did any of this surprise you? Was there a rule here you thought worked differently? A myth you believed until today? Because the comment section of this video is one of the most valuable resources in precious metals education. Not because of what I say, but because of what other stackers share about their own experiences navigating these rules. Every comment teaches someone else. Every question raised publicly is a question that 20 other people were too uncomfortable to ask. That exchange is where real financial education happens, so be part of it. And remember, this is for education and discussion only, not personal financial advice. Your situation is specific, your tax picture is your own, and the rules discussed here are general frameworks that a qualified tax professional must apply to your individual circumstances before you make any decisions. The goal is informed conversation, not a substitute for professional counsel.